The International Financial Law Review's inaugural IFLR European Inhouse Counsel Summit took place in London on January 24th of this year. Thanks to our sponsors, the event brought together in-house counsel from top European corporates and banks. There was special focus on matters relating to financial law, including M&A, capital markets and competition. The chair of the summit's capital markets panel, Mayor Brown's Bernd Bohr, spoke with IFLR about the risks he expects to develop in Europe's high-yield market this year.
Thank you very much for speaking with IFLR today, Bernd. 2012 saw strong demand for high yield. So do you expect this demand to continue in 2013, and if so, why?
The answer is yes, I absolutely expect the demand to continue. And I think there's a number of reasons for this. One of them is maybe kind of a general trend. If you compare Europe to the US, I think traditionally companies have relied far more on bank funding. I think in the US for years it's been far more common for even small, medium-sized companies to access the capital markets. And I think Europe just simply has some catching up to do. I think in the aftermath of the financial crisis, I think that trend will accelerate because issuers in many cases simply just do not have a choice. Banks are being told by their regulators to reduce their balance sheets, strengthen their risk controls and reduce exposure. So unfortunately a lot of finance directors, kind of CFOs of companies, having meetings with their relationship banks that they've been relying on for many years, and that unfortunately they have to reduce exposure, can't renew facilities, and the only option to really close that funding gap is in many cases the capital markets. And for issuers that unfortunately are non-investment grade issuers, that means high yield offering.
Okay, how do you expect the structure of the product and associated covenant terms to develop this year?
I think with high yield, I think it's important to point out that high yield, I think is always a tailored, customized product. I think there may be certain usages, traditional features of a high yield deal that you would start with and that you would expect initially, but you always need to make sure that whatever you're negotiating works for the specific company, for the specific industry, and also allows both the issuer sufficient flexibility to execute on business plans. Very often you talk about turnaround stories. It's important that the issuer has the flexibility to turn the business around, bring it forward, and hopefully improve its credit, and at the same time preserve certain protections for investors. At the same time also, I think when we talk about high yield, many different people have different views what that means. I think one definition of high yield is of course debt offerings by non-investment grade issuers, issuers that for various reasons have fallen on rough times, maybe are stage of the economic cycle where they're struggling. But within that universe, I think you see a lot of different types of transactions. You have the traditional New York law governed high yield package, because that's where high yield initially developed almost 3 decades ago, and that is typically something that you see for minimum transaction sizes of maybe 200 million, 250 million euros. Again, traditionally New York law governed. You're talking about larger issuers. You're talking transactions where you have larger banks, kind of US lawyers involved. You also sometimes see even when you have local law governed transactions, German high yield, for example, covenant packages that are traditional high yield covenant packages. You then also see, especially in the smaller size segment, kind of transactions that are too small to justify the legal expense, too small to attract larger financial institutions. You see small and medium-sized companies that are high yield credits, but that are accessing different segments of the market. In Germany, for example, there's a significant market, the Freiverkehr, Mittelstandsanleihen, so-called M-bonds, relatively small companies manage to place decent size offerings that are highly risky, but the yield of course is attractive for for many investors. And then, of course, you have fallen angels, which is how high yield in the US originally developed. You have issuers that used to be investment grade because of the financial crisis, because of the Eurozone crisis, or other developments. They're suddenly finding themselves in the high yield, kind of non-investment grade universe, but because they're so well known in the market, have existing debt issuance programs, have investors that have been following the name, have managed to keep accessing the capital markets with documentation that is little changed from the good old times when they're still investment grade.
How will the high yield investor base change this year, if at all?
If I knew that in a crystal ball, I think I could probably make a lot of money. But one thing that I can say is that the high yield market is white hot at the moment. You see deals that get upsized. Issuers are issuing more than they initially planned, just because the pricing is so favorable. Investors are chasing yield, and I think deals are also getting priced early. People plan for like a 1-2 week roadshow, and then after 3 days they say books are full, we can price now. One trend that you do see is that I'm not sure that it's a trend or that it's necessarily a good idea, is that you do occasionally find transactions that have a retail component. Most high yield deals, especially the traditional kind of New York style high yield deals, are listed on unregulated markets here in Europe, and their wholesale offerings, very large minimum denominations. But there are in certain countries and for certain issuers, there's a retail component. You're selling a relatively small, tickets to retail investors. Partly because you want to maybe involve employees, give them an opportunity to participate in like an improved performance of the company, hopefully kind of over time, or you try to capitalize on potentially brand recognition.
Right, and finally, what risks do you think these developments pose for in-house counsel?
I mean, especially kind of when you're looking at or considering a retail bond offering, I think it's not so much that you can't do it from a legal perspective, that you can't include appropriate risk factors, appropriate disclosures about the business. You would do that in any case. I think even with an offering to just institutional, more sophisticated investors, when you do target retail, I think you need to think about general suitability. I think you need to ask yourself the questions of mostly the financial institutions, the brokers that are approaching their customers, their investors, their clients with these offerings, whether this is the right product for the individual. If you're talking, for example, to somebody that is close to retirement, wants to invest in high yield, is tempted by the yield that is more than zero, which is what you're getting on your savings accounts, whether that is something that is suitable for the investor. Of course, when you're selling to your employees, it would be nice. You can have very happy employees if everything goes well and the price of the bonds improves. We'll have very unhappy employees, of course. It's the same with equity offering to employees if the price of bonds falls.